You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. So just talking a little bit about, just laying the premise for our conversation to talk a little bit about Blackstone and what's going on there. And this is one of the things that, we warn a lot about, over time is that, we meet with a lot of individuals that have invested in private placements of some sort or another. And during the bull market phase of the market, it's all fine, right? Because they're going up in value and you see it on your statement and they're making distributions. It's all good. Problem is when things aren't good. And, back in the late 90s, there was a, well-known radio show host around the country at that time, and he was promoting this thing called a bucket strategy. And, part of that bucket strategy was putting money into a private REIT that, he had ties to, et cetera. And, it was fine until you couldn't get your money out of it. And things didn't go well during the financial crisis. And, this thing was supposed to go public on multiple bases so you could exit the strategy, and it just never occurred. And it just became a real problem. And of course, this is the way these things always work. And let me lay out a real simple premise here so you can understand kind of what we're talking about with what's happening with Blackstone or REITs in general. Mike and I, we go out and we buy an office building. We have $10 million and we buy a $10 million office building, right? And so we put that into a portfolio. And of course, the $10 million we got was we raised the money from you. You sent us the $10 million out of your investment accounts and we put it into the fund and we bought the building. So now we own the building and we're operating the building. The building is generating some cash flow. And so as the building generates cash flow, we distribute that cash flow back out to you, less the management fee and less our asset fee, right? So you are getting these distributions and it's all fine and dandy. It's great, right? You're like, man, I own an office building and I'm getting my share of the distribution. I'm getting these payments and it's fantastic. Works great. And then all of a sudden a pandemic comes along and we shut down the economy and nobody works at the office building anymore. Rents get canceled. Now all of a sudden that cash flow drops markedly. Well, the problem is now, we've got, Mike and I were kind enough when we set up the fund. We gave people the option if they wanted to redeem out of the fund, they could at some point. So we would just take some of the operating cash flow, and Brent wanted out of the fund. So we would send Brent his, $50,000 that he put in out of the cash flow. We distribute the rest of the money. Well, the problem comes when everybody wants to get their money out at one time. There's only so much cash flow coming out of that building. There's only so much cash in the kitty, and I can't meet all those redemptions unless I sell the building. But I can't sell the building right now because interest rates are high. Nobody wants to own an office building because nobody's renting it, right? And what drives the value of an office building in this example is occupancy, right? So values are way down. So now I'm in trouble. So what do I do? Well, the only thing I can do is just tell everybody you can't get your money back. It's called gating. And you'll hear this term a good bit on equity funds and private equity funds and other private placements. When bad things occur, they'll say we're gating distributions. What that means is they're putting a gate up, and it just basically means you can't get your distribution out. So if you want your money back, you simply can't get it. You're just going to have to wait until Mike and I, at our discretion, are able to dispose of the building. And that might take years in some cases for that to occur. So that's just a real simple example. I hope that kind of lays down the background. This is the way it operates, though, for a lot of different, whether it's a private equity investment or whatever it is, they all kind of operate the same. So, Mike, let me just let you jump in here, give you your kind of hit the highlights, and let's talk specifically about what's going on with Blackstone right now.
Yeah, no, that was a great explanation. And that's exactly Blackstone's problem, is that they have a large number of people that want their money back, and they have two choices. They can either gate the fund and not give them a small percentage of their money back, or they can sell real estate, which, in normal times, maybe they would do that. Mm-hmm. In these times, the real estate market for almost anything is illiquid because of high interest rates. So a lot of customers want their investment back. They want their money back. They're not getting it. They're getting, a couple percent of their money back. So there's a lot to unpack here. The first one is just contagion. If I am a pension fund, for instance, and I have 20% of my money in private equity, and we go to our investment committee meeting and we say, you know what, there's a recession coming. Let's take down our risk levels a little bit. So let's reduce our exposure in private equity from 20% to 15%. And at the same time, we'll buy bonds or sit on cash, whatever we're going to do. So you say, okay, we have to get our private equity, private investments down from 20 to 15. Let's sell that Blackstone fund. We go to Blackstone. Hey, we need to sell a whole bunch of this so we can get down to 15%. They say, well, you can't. You're only going to be selling 1 million worth today. And that gets us to 19%. So we still have 4% more to sell, meaning that we're going to have to sell other private assets. And all these other private assets potentially have very similar problems. They don't own stocks or bonds that can be easily traded. They own assets, and the reason they pay higher rates of return is because they own assets that are less liquid. And you say, okay, well, let's go to these 4 other funds that we own and let's try to sell them. And then all of a sudden they get gated. And now you get worried. Let's just try to sell all our private equity funds. And maybe you get down to 15% doing that. Or maybe you're like, you know what? These things aren't liquid. Liquidity is at a premium now. Let's just sell whatever we can. And that's the contagion risk that is starting to form here. And the word I used earlier was liquidity. Lance and I have talked about liquidity over and over again, and we've talked about the lag effect of what the Fed's doing. And this is another domino. This is just like the UK pension funds with their treasury, with their UK treasury bonds. This is FTX. When the liquidity dries up, leveraged illiquid speculative investments start to go by the wayside. And this is just another example where the Fed's actions take a long time, but they're slowly catching up to some of these assets. And this thing could resolve itself very, very nicely. Maybe Blackstone sells a building or two, they meet everyone's needs, and there's not this rush to sell private investments, but maybe it doesn't. And the problem is, as the Fed keeps doing 95 billion of QT every month, as they continue to raise rates, which they may not be as aggressive as they were, but they're still raising rates, and rates are still very high, even if long-term yields are starting to come down, that all pulls liquidity from the system. And as a result, you're starting to see more chinks in the armor, more of these illiquid investments starting to, fail's not the right word, but starting to take on problems that can, even though the underlying real estate may not be a problem, the fund structure itself can be a problem because they have to sell illiquid real estate that they can't sell.
Right.
And Lance, if we go back to 2008, what was interesting is there were a lot of people that held subprime. That market was closed. So when they wanted to take off risk, to de-risk their portfolio, they couldn't sell subprime. In a lot of cases, they were selling regular government-guaranteed mortgage-backed securities, U.S. Treasuries, corporate investment-grade bonds. So you can see how, like in the subprime instance, if something's closed, like this private equity, and liquidity is needed, something else has to be sold. So, it's not always the worst, the most speculative, the most illiquid assets. Sometimes that can gravitate towards very liquid assets if money is needed.
Yeah, and if we go back to 2008 is a good example of that, right? Bear Stearns was, what brought down Bear Stearns is they had 2 big hedge funds that were, called high yield funds that were invested heavily in, all kinds of different subprime mortgages and everything else that were thought to be very safe. When they became illiquid, big demands for return of capital, couldn't meet it. And then, of course, that wound up bringing down the whole investment bank. So, and to your point, this is one of the important things about private equity. It doesn't mean that, investing in private placements and those type of things don't work out well. They can, and they can do well. But there are times, and it's kind of like those multi-level marketing deals where if you're the first guy into the multi-level marketing program, you do well, right? It's the last guys in that don't do well. And it's the same thing with private placements. If you're the first guy in and the first guy out, you're okay. It's the last guys trying to get out of these things that wind up getting in trouble. So, it's always better to be early, right, Mike? And
there's a lot of last guys given last year's bullish run into illiquid assets.
Exactly. And so this is the one thing that is to always look at, is that this happens over time. And when we see this, the more greed there is, then the more that these funds just start throwing in, more and more programs, right? So they just start buying more and more assets. And again, when you have too much money chasing too few assets, what happens is that the quality of the investments go way down. And that really increases the risk that when you get into the next economic recession, downturn, whatever you want to call it, that's when the lack of quality shows up in these investments, and that's where you find out exactly what you own. Remember, too, just very quickly, when you get these prospectuses, always tell you the internal rate of return on this investment is 16%. It's based on the most optimistic assumptions. That's not history. It's not what the fund has done over the last 10, 20, 30 years, right? It's what they're expecting it to do based on the most optimistic of views. And those typically don't work out over time as well as they always purport that they will. Be right back after the break. We'll wrap up our conversation. What does Blackstone potentially mean for the rest of the market? We'll talk about that. Don't go away.
The Real Investment Show.
And welcome back to the show this morning. Mike and I just talking a little bit about Blackstone private investments in general and the potential risk to financial markets. And just for the break, we were talking a little bit about greed, right? And when you have a lot of capital flowing into markets and again, too much capital chasing too few assets, you get this kind of greed cycle. And just an example of this, just as really just to make that point, right? In 2020, as of December 31st, 2021, AUM, which is the assets under management for Blackstone, was reported. Now, here's the interesting thing. So remember in 2020, 2021, what did we have going on? $5 trillion worth of money being poured into the economy by the federal government, $120 billion a month in quantitative easing by the Fed. Right? So we just had massive capital inflows coming into the markets from all different angles. The capital, the assets that Blackstone managed in 2021 almost doubled. It was up 42% on a year-over-year basis from 2020. So that just goes to show you, right? There was this greed. I have all this capital. Where can I put it? Oh, well, Blackstone's telling me I can get to this private equity placement, this private REIT, whatever it is, and I'm going to make 15, 16% a year on my money. Why would not, as Mike said earlier, why wouldn't you put your money there, right? Risk and reward. Now, here's the important thing. As we've talked about, Mike and I have talked about here on the show before about financial instability. And the one thing we're watching for is those risks of financial instability, because what's going to cause the Fed to pivot? What would stop the Federal Reserve from hiking rates and go immediately back to dropping interest rates and doing QE? And that would be financial instability, right? A threat to the financial system. Most people don't remember. Mike does, because he's as old as I am almost. He's still a kid. He's younger than me, but he's getting there. 1998 was a small little highly leveraged hedge fund started by a bond trader in 1994 following the bond market crash, when the Fed was hiking rates, by the way. They started this little hedge fund called Long-Term Capital Management, which at its peak managed $126 billion. When it failed, because the Fed was hiking interest rates, it required a massive bailout from 14 banks to get that long-term capital management problem solved. Now, that was back in 1998. Asset markets are a lot bigger today. The point is that now you've got FTX, we've talked about recently, which is blown up. That's only $30 billion. Not that big of a deal. Market can absorb that. But now, potentially, and I'm not saying Blackstone's about to go bankrupt by any stretch of imagination, but you've got a firm of $880 billion that's sitting in highly leveraged assets, right? Real estate. It's a highly leveraged business. Now, again, I'm not telling you right now that Blackstone's the next black swan event. It's Bear Stearns, but here's the point I am making, is that these are the things that Mike and I have been talking about in terms of financial instability. These are the cracks in that foundation of financial stability, which is so imperative to the Federal Reserve and their monetary policy. As long as everything is operating, they can keep hiking rates. The problem is when something breaks. And again, I want to be clear. I'm not saying that Blackstone is that straw that breaks the camel's back, but these are the things that you're kind of looking for, because we're also seeing credit risk. We're seeing leverage loans, risk rising. We're starting to see some of those other cracks in the credit markets as well. They're not pronounced yet, but they're starting to show up. Mike, your point.
Yeah, and like you said, Blackstone is not going to default, at least certainly not on this fund. They just manage the fund. Now, what they will lose is a whole lot of revenue. Apparently, they're charging over 3.5% a year to manage this fund. So they are going to lose a lot of revenue, but it's really the people that own the fund that are going to be the losers. They're the ones that are going to take the risk. So, worst case, they have to divest of all the real estate assets. They're going to sell the assets, get whatever they can get, and pass it on to their fund holders at, 50 cents on a dollar, 30 cents on a dollar, whatever it may be. Blackstone, though, is not necessarily at risk because of this one fund, but it's that contagion. It's the dominoes. Mm-hmm. What happens when three big investors all of a sudden have to cut their investment, the value of their investment in half, and they're over levered? And that's the problem. It's not necessarily the obvious points of failure that are concerning. It's the ones we don't know. There's so much leverage in the system. Which banks have leveraged out, have loaned out money to some of these big investors? Long-term capital, based on what they were doing, were buying simple arbitrage trades. They would buy security A, sell security B at a price difference, knowing full well that virtually guaranteed that the price of A and the price of B will be the same in 30 days. That's arbitrage. And it's not risk-free arbitrage, but it's guaranteed that in a certain amount of time, A will equal B and that their investment will pay off. The problem is that between the point they put the investment on and the point where they were supposed to be paid off, the difference between A and B became much wider. They were using a lot more leverage. They had to back out of those trades and realize some, backbreaking losses. So, even in quote unquote risk-free trades, there's a risk to the system, and that's liquidity. It's leverage. It's the fact that they're not investing like you and me, where they have $100, they invest $100. Worst case, the $100 goes to zero. They're investing $10, borrowing $90, and when you have a $20 drop in the price of the asset, all of a sudden you not only lost your $10, you're actually out $10. Mm-hmm. So that's why leverage is so important, and that's why liquidity is so important, because when liquidity dries up, leverage dries up, and we have an economy and financial markets that are built on extremely large amounts of leverage, of debt. So, the Fed's pulling out $95 billion of liquidity a month. The interest rates on that liquidity, on that leverage, have shot up. It used to be very low. Now they're up 3 or 4% from where they were. So all those bets don't make nearly as much sense today as they did a year ago, when both liquidity was flowing and margin debts or leverage costs were much lower. Mm-hmm. And this is the unwind of the fantastic amounts of liquidity that were pumped into the system, a year and 2 years ago. And as long as the Fed keeps on this path with both higher interest rates and removing liquidity, we should expect to see more dominoes. And the question, and it's one we can't answer, is which is the domino that breaks the camel's back, so to speak? Which is the one that somehow is affiliated with a major bank or a major brokerage firm, or requires them to sell assets that will create problems? And we don't know. Is it Blackstone? I don't know. Probably not. But is Blackstone just going to create another domino, and a domino after that is the one that gets the Fed to pivot? Could be. And Lance and I use the phrase all the time: the Fed's going to go until they break something. And this is what we mean by breaking something. It by default, they will break something if they keep pulling liquidity out of markets. That's just the way it is, because there's not enough debt to support the assets if they keep pulling liquidity. The question is when, and do they stop before they get to that point? And that's why we're going to keep following Blackstone and other potential areas for problems.
Yeah, and again, I also want you to take away from this conversation that Mike and I are having with you that this doesn't also mean that we're telling you that the market's about to blow up, we're about to have another financial crisis. We're not saying that at all. What we're saying is there's risk, and we're watching that risk carefully. These are the things you want to pay attention to, but it doesn't mean that the world is going to come to an end and you should be in a bunker with gold and beanie weenies and ammo, right? It just, we have to manage risk, and that's what we're talking about here. And we're watching that risk. This is why we're heavily underweight equities in our portfolio. We're very overweight cash because we are concerned about the risk right now. But if miraculously somehow the Fed is able to navigate into a soft landing scenario, Mike and I have talked about this before, and this is a discussion that Mike and I have literally every day. How on earth do we navigate into a soft landing scenario, right? Employment, is still strong, right? Job growth is still strong. Unemployment rates are still low. We don't see any real stress in job openings and labor turnover yet. So maybe consumer spending is doing okay. People are able to take on more credit card debt and keep spending. So maybe we can navigate some type of soft landing scenario where the economy slows down towards zero but doesn't go into a recession and nothing breaks. There's a possibility that could occur. The problem is when we start layering up all the other indicators in the markets and the economy certainly suggest the risk of recession is a lot higher than we would like. And there's certainly risk to equities in that environment because earnings will have to come down. But a recession doesn't necessarily mean that the world breaks and we're back into the Stone Ages again. So, it's important to keep a good balance on what's going on in the markets, understanding what the risks are, and then equating that back to how your portfolio is allocated and how you're managing that risk in your portfolio. As we talked about before, trying to avoid the crash has cost investors more money than the crash itself. And this is just something to always try to remember when you manage your money is, don't manage for the worst outcome, manage for the most possible outcome. That wraps up the show for the day. Mike, thank you so much for joining me. Of course, it's Thursday. Tomorrow, Danny Ratliff and Richard Russell will be here for Financial Fitness Friday. Get by the website, Mike's latest article, Double Dog Dares and Equity Risk Premiums. That's on the website now, realinvestmentadvice.com. Of course, check out SimpleVisor, our research platform. There it has all of our research and analysis that we do when we manage portfolios. It's on that website, simplevisor.com. Have a great day. We'll see you back here tomorrow.